Okay, welcome everyone. We're going to be starting this webinar now, Student Loans 101, specifically on refinancing. I'm here with Mark Kantrowitz. He's the publisher and VP of Research here at savingforcollege.com. We provide a host of information on student loans, financial aid. Basically, any question you have about the financial aid student loans process, we have the answer. And Mark here is the top expert when it comes to this topic. He's quoted in more than 10,000 newspaper and magazine articles, and not just any newspapers and magazines. We're talking Wall Street Journal, Forbes, big names. He's also testified multiple times in Congress and other state agencies. So Mark is really the go-to when it comes to student loan origination and refinancing. I know all of you have a lot of questions. Mark is going to begin with his presentation, and right after that, we're going to start a Q&A. If you guys do have questions, there's that chat box at the bottom, like banner of the Zoom window you have open. Type away. I'll be aggregating those questions. My name's Julian, and without further ado, here's Mark. Thanks, Mark, for joining.
Thank you, Julian. So today we're talking about how to refinance a student loan. In the two previous webinars, we talked about how to borrow student loans and how to repay student loans. Next week, we'll talk about loan forgiveness. So let's talk about the refinancing. There's actually two different terms that you may hear, consolidation and refinancing. The term consolidation is usually used in connection with federal loans, while the term refinancing is used with private student loans, although some people will use the two terms interchangeably. Consolidation and refinance both combine multiple loans into a single loan. The interest rate on a federal consolidation loan is based on the weighted average of the interest rates on the loans that are included in that consolidation loan, and it's rounded up to the nearest 1/8 of a percentage point, or a multiple of 0.125%. The interest rate on a private refinance, however, is based on the current credit scores of the borrower and a cosigner, if any. This will yield a better interest rate if your credit scores have improved. But generally, soon after graduation, your credit scores are going to be lower at their lowest point because your credit utilization has gone up each year you've been in school, causing your credit scores to go down, and they're lowest when you graduate. However, a few years after graduation, your credit scores will improve if you've been managing your credit appropriately and responsibly. That means paying every bill, not just the student loans, on time by the due date, and having a steady job. So instead of, recent college graduates have a tendency to switch from one job to the next within a year or two. Lenders like to see signs of steady employment for at least 2 years. Then you will have an improvement in your credit score. You might be able to refinance without a cosigner, or you might be able to get a much better interest rate when you refinance. But the idea that you can refinance private loans immediately after graduation and get a better rate doesn't play out in practice. Now, with both the consolidation and refinance, there are no prepayment penalties as a matter of law, and there generally are no fees to consolidate or refinance. Now, any interest that's accrued but is unpaid on your loan will be added to the loan balance when you consolidate or refinance, because consolidation or refinance is a new loan that pays off the old loans, and that new loan has to equal the total outstanding liability, which includes not just the outstanding principal balance, but also any accrued but unpaid interest. And we already discussed how the interest rate is the primary difference, but there are other differences among the loans. What loans are eligible? On a federal consolidation loan, you can only include federal loans. You cannot use private student loans, include private student loans in a federal consolidation loan. Whereas with a private refinance, you can, in many cases, include both federal and private student loans in that refinance. Another difference is the availability of fixed versus variable interest rates. The interest rates on a federal consolidation loan are fixed interest rates. There is no variable interest rate option, whereas a private refinance may give you a choice between a fixed and a variable interest rate. right around now where interest rates are at historic lows, you probably should prefer a fixed interest rate because the variable interest rates have nowhere to go but up, even though the nominal current interest rate on a variable rate loan may be lower. But there may be some circumstances in which it is better to choose a variable interest rate, like if you are capable of paying off that debt in full and expect to do so within a few years, well, then you're taking advantage of the period of time when the interest rate on a variable rate loan is lower, and you're going to pay it off before the interest rates rise too much. The repayment term and repayment plans may differ. This is especially important with a private refinance because the interest rate, a fixed interest rate on a private refinance will tend to be lower if the repayment term is shorter. So you will have a lower fixed rate on a 5-year term than on a 10-year term. And that's because there's an expectation that the cost of the loan will go up as more time passes. And so if you have a longer term on a fixed rate loan, the cost of that money will go up. So the lender reflects that by having a higher interest rate on a longer term loan. On the flip side of the coin, they offer 5-year loan terms as low as 5 years because that lets them advertise a lower interest rate. Now, we said that the interest rate on a federal loan is based on the weighted average of the interest rates on the old loan. So what exactly is this? When you calculate the weighted average, you're taking each loan's interest rate and multiplying it by the corresponding loan amount, and then dividing the total, the sum of all those products, by the total debt. So it's essentially having each loan's interest rate contribute to the weighted average in proportion to the loan's percentage of the total debt. And we have an example here where we have two loans, a $5,500 loan at 4.529% interest. That's the current interest rate on an undergraduate Stafford loan, and a $6,500 one at 2.75%. That's the new interest rate that federal loans will have starting July 1st of 2020. And I just picked these kind of arbitrarily, aiming to have different loan amounts and different interest rates. So when we multiply each loan balance by this corresponding interest rate, we have 5,500 times 4.529% and 6,500 times 2.73%. Those products sum to $427 and change. Divide that sum by the total debt, which is $12,000, and we get 3.56%, with some odd fraction. Now, if we round this to the nearest 1/8 of a percentage point, we're going to get 3.625%. In other words, 3 5/8 percentage point. So now let's see, what does the weighted average really mean? So the mathematics behind this means that the weighted average is going to not be the highest rate, not going to be the lowest rate, but it'll be somewhere in between. So when you hear a lender say that the weighted average reduces the interest rate that you pay, well, it is reducing the highest rate, but it's increasing the lowest rate. So you need to take that kind of marketing with a grain of salt. Okay. Another impact is that because you're weighting it by the loan balance, the loans that have the greater loan balance are going to have more of an impact on the overall weighted average than loans that are much smaller. So in that previous example, we had 6,500 at 2.75%. That had a greater impact than the 5,500 at 4.529%. And so the weighted average was closer to 2.75% than it was to 4.529%. Now, because each loan is having an impact based on its loan balance and its interest rate, it's effectively preserving the cost of the loan. It's not perfect, but it's pretty close. And that's the intention, that this isn't like a refinance which gives you a brand new interest rate that may be lower. This is really just similar in cost to the original loans. each loan is contributing based on its own interest rate when you compute the consolidation. So consolidation actually doesn't really save you any money because that interest rate is going to be quite similar. And it even costs you a little bit more because of the rounding up to the nearest 1/8 of a point. The only way to save interest on a consolidation loan is if you choose a shorter repayment term. That yields a higher monthly payment, which will cause you to pay off the debt quicker and save you money on interest. So let's go into a little bit more detail on the impact of the weighted average on the loan cost. So we're using the same two loans as before, $5,500 and $6,500, and we're using a 10-year repayment terms because now we're calculating the actual monthly payments. So before consolidation, we had two loans. The $5,500 loan had a monthly payment of $57.08 a month, and the $6,500 one, which had a lower interest rate, but it still was more debt, that was $62.02 per month. So when you sum those two together, you get $119.10 per month, and you get total payments of $14,291 and change. So then let's look at what happens after consolidation. It's one loan, $12,000. It's at 3.625%. That yields a monthly payment of $119.37. That's 27 cents more than before. And we'll show that that's largely due to the rounding up of the interest rate. And the total payments is $14,324. So a little bit more, $33 more in total payments. So it's not significantly affecting the cost of the loan. It's just slightly higher. Now, a lot of that difference is due to the rounding up of that interest rate. If we didn't round up that interest rate, instead had that very long decimal point, so it's a little bit lower than 3.625%, the monthly payment would be $119.03 per month. So that's only a 7-cent difference. And the total payments would be $14,284, which is actually a little bit lower. And that's because the monthly payment would be a little bit higher, even though it's effectively a shorter repayment term. Now, one thing about this example, I specifically chose loan amounts and interest rates so that the monthly payments would be more than $50 a month. Because on federal loans, federal Stafford loans, there's a $50 minimum payment. So if the calculated payment were less than $50, it would get rounded up to $50, and then consolidation would reduce the total monthly loan payments because that loan that was less than $50 would be paid off sooner. And so I wanted to keep this example a little bit pure. So now let's shift to why should you consolidate your student loans. We're going to give you the pros and the cons, the advantages and the disadvantages. So first, one reason is if you want to change the repayment term on your loans. A longer repayment term is going to reduce your monthly loan payments, but increase the total interest you pay over the life of the loan. A shorter repayment term will yield a higher monthly payment, paying down the principal balance of your loan quicker and reducing the total interest you pay over the life of the loan. So ideally, you want to choose the highest monthly payment you can afford so that you save the most money on interest. Now, the federal consolidation loans offer extended repayment plans, but there are two different types of extended repayment plans. With consolidation, your monthly payment, your repayment term is based on the total amount of debt. It can be 10, 12, 15, 20, 25, or 30 years. For example, a $20,000 loan has a 20-year repayment term, $40,000 has a 25-year repayment term, and $60,000 has a 30-year term. Without consolidation, there is only one option for extended repayment, and that's for borrowers who have at least $30,000 in federal student loan debt. They get a 25-year term. You don't see a lot of this information coming out of the U.S. Department of Education, but that's what the law says. Now, you can also change the repayment plan on your loans. With federal loans, You can get an income-driven repayment plan. Now, some of the federal loans have only income-based repayment available to them. That's for loans in the FFEL program. By consolidating into the direct loan program, they get all 4 income-driven repayment plans: income contingent repayment, income-based repayment, pay-as-you-earn repayment, and revised pay-as-you-earn repayment. Also, federal Parent Plus loans are not themselves directly eligible for an income-driven repayment plan, but if you consolidate a federal Parent Plus loan that entered repayment on or after July 1 of 2006, that consolidation loan is eligible for income contingent repayment. So if you're a parent who's pursuing, say, public service loan forgiveness, or you just want an income-driven repayment plan, consolidation can give you access to that. Another common reason is you want to switch from one loan servicer to another. On federal loans, when you consolidate them, you get to choose your loan servicer. You don't get to choose the loan servicer on the original loan, but you do get to choose it on the consolidation. Another benefit of consolidation is to just simplify things, and you might graduate, be with 8 to 12 federal loans and maybe some private loans. Well, consolidating your federal loans together gives you a single loan instead of multiple loans, and that can simplify the repayment process. These days, most lenders will give you unified billing so that you get one invoice, but it's a lot easier to understand and manage if you have just one loan. Another reason why you might want to consolidate is if you're in the FFEL program or you have federal Perkins loans and you want to qualify them for public service loan forgiveness. That's available only in the direct loan program. You can consolidate them into a federal direct consolidation loan and thereby get them eligible for that loan forgiveness program. If you're in default on your federal loans, there are 2 methods of rehabilitating the default, which involves getting that default off of your credit history. One is to make 9 out of 10 consecutive full, voluntary, reasonable, and affordable monthly payments. The other is to consolidate into a direct consolidation loan with a requirement that you repay that loan in an income-driven repayment plan. You won't have the option to switch into other repayment plans. So that's one method of rehabilitating a defaulted loan. And another thing is that a consolidation loan is a brand new loan. It pays off your own loans, but it's a new loan. And it gives you a new set of deferments and forbearances because those are on a loan basis, not on a borrower basis. So on federal loans, you can get up to 3 years of certain deferments, up to 3 years of forbearances. So you have the economic hardship deferment, unemployment deferment, and forbearances. That's a total of 9 years of suspended payments. Well, if you consolidate them once you've used up those deferments and forbearances, you get another 9 years of deferments and forbearances. So this is why you should consider the advantages of consolidation. Now let's look at the disadvantages, why you shouldn't consolidate. Well, one thing, one of the benefits of consolidation is that you're getting a single loan, but that means that you can't target the loan with the highest interest rate for quicker repayment because there's just one loan now. So sometimes that you're better off keeping the highest rate loan separate so that you can pay it off quicker. One option would be to consolidate your loans excluding that highest rate loan so that you'll still have 2 loans, but then you'll be able to continue accelerating the repayment of that highest rate loan. Okay. Now, another reason that you might not want to consolidate is it's not really going to save you any money and actually increases your costs very slightly because of the use of that weighted average. And there is a tendency for people to choose a longer repayment term when they consolidate. And a longer repayment term means you're paying more interest over the life of the loan. If you are not pursuing public service loan forgiveness, but rather you're in the income-based repayment plan and you're planning on getting the forgiveness after 25 years in repayment under income-based repayment, well, when you consolidate, because that's a new loan, it has a new repayment term, it resets that clock. So any payments you made under that income-based repayment in the federal program don't carry through to the direct loan. So that may be a reason not to do it. If you've been already in an income-based repayment plan for 10 years and you have only 15 years left, if you consolidate, you have a full 25 years to go again. Another problem with consolidation is that you lose the remainder of your grace period. So there's a 6-month grace period after you graduate. If you consolidate after just 1 month, you lose that 5 months remaining on your grace period. One workaround would be to wait until the end of your grace period to consolidate. In fact, there are some lenders that previously, when there was a bank-based consolidation loans, they would hold your application until the end and then consolidate it for you. Now, federal Perkins loans, if you include them in a federal direct consolidation loan, you're going to lose all of the superior benefits of the Perkins loan. In particular, there's a 9-month grace period on the Perkins loan. You lose that. The interest on a Perkins loan is subsidized. It becomes unsubsidized when you consolidate it. And the Perkins loan includes many, many loan forgiveness options. You lose all of them if you consolidate. You do get the public service loan forgiveness as an option on a federal direct consolidation loan, but that's about it. And if you choose to increase the repayment term, even if you're not consciously doing it, but let's say you were in a 10-year repayment term before consolidation and they're sticking with a 10-year repayment term after you consolidate, well, let's say that you were 3 years into that 10-year period. When you consolidate, you're going back to a full 10 years. So you are increasing the repayment term, even if you're not really intending to do that. And that means you're going to pay more interest over the life of the loan. And then finally, you can't reverse a consolidation. You can't undo it. So if you are going to consolidate, be sure that this is what you really want to do. Now, we just talked about consolidation, which is for federal loans. Now let's talk about why you should and should not do a refinance on the private loans. So one reason is to get a lower interest rate. If your credit scores or your credit scores of your cosigner have improved, you may be able to get a lower interest rate and you will save some money. Even if you're including federal loans in a private refinance, those federal loans may be from several years ago when they had a higher interest rate. And so even if your credit scores haven't improved, you may be able to get a lower interest rate and save some money. Okay. Now, most private student loans do not allow a change in the repayment term on a fixed rate loan because their costs are tied to the length of the repayment term. So the only way to get a different repayment term on a private student loan that has a fixed interest rate is to refinance it. That will be a new loan which has a new repayment term. And longer repayment term will reduce your monthly payment, easing your budget. That might help you qualify for a mortgage or other types of credit because it will reduce your debt-to-income ratio. On the other hand, if you choose a shorter repayment term, you'll pay off your loans quicker. Now, you may want to change your loan servicer. If the lender does not outsource their loan servicing to another lender, then changing your lender by refinancing with a different lender may involve switching to a different loan servicer. But you need to look into this in advance because some of the lenders will outsource their loan servicing to like AES FIA. They're one of the more popular outsourcers. They service a lot of loans. And if you don't like them and your current lender uses them and you refinance to another lender, well, that other lender might also use them, in which case you're not changing your loan servicer. And as with the consolidation loans, refinancing will replace multiple loans with a single loan and thereby simplify the repayment process. Now, many private student loans have a requirement that you have a cosigner. More than 90% of private student loans to undergraduate students have a cosigner. Now, many lenders have cosigner release options. And if you make a number of payments on time by the due date. Varies by lender. It could be 12, 24, 36, or 48 on-time monthly payments, and you satisfy the credit criteria, your cosigner can be released from their obligation to repay the debt, which will make them happy because maybe they're trying to refinance their mortgage, and having a lower debt-to-income ratio will help them qualifying, maybe get them a lower interest rate. But some lenders don't have cosigner release, or maybe you're with a lender that has 48 months of cosigner release and you want to get it sooner. And mind you, only 10% of borrowers will qualify for cosigner release that apply for it. Well, if you refinance your loans without a cosigner, the new loan pays off the old loan, effectively releasing your existing cosigner from their repayment obligation, and the new loan doesn't have a cosigner. So this is a good workaround for loans that don't have a formal cosigner release option. Now, we talked about the advantages of refinancing. Let's talk about the disadvantages. So you will no longer be able to target the highest rate loan for quicker repayment. So you might want to either keep that highest rate loan out of the refinance, or maybe you refinance just that highest rate loan to get a lower interest rate on it. Because what you have to do is look at what interest rate you're going to get from each lender based on your credit score and the credit score of your cosigner, if any. And you need to compare that with the interest rates on your existing loans. Now, if the interest rate that you're getting is among those interest rates, then you're going to have lower costs on the loans that have a higher interest rate, but higher costs on loans that have a lower interest rate. So you might want to be selective in which loans you refinance. You might, if you compare the weighted average of your existing loans interest rates and compare it with that new interest rate, if that new interest rate is higher, it's actually going to increase your costs. And it's obvious if the new rate is higher than your highest interest rate, it's clear. But even if it's in the mix of them, it could actually be a more expensive loan. And you may not realize this until you do some careful math using a loan repayment calculator to see what your monthly payments are and your total interest over the life of the loan. So you really need to do a little bit of homework comparing the new interest rate with the existing interest rates and also with the impact on your monthly payments, and try to keep the loan term the same when you're doing that kind of comparison, because if you have a longer repayment term, you might have a lower monthly payment but higher total interest over the life of the loan, and that makes comparing the impact of the interest rates harder. And you need to consider this carefully because let's suppose that that new interest rate is lower than your highest rate loan but higher than all your other loans. You may actually save more money if you don't consolidate but target that highest rate loan for much quicker repayments. Or maybe you want to consolidate refinance just that highest rate loan. And another reason why you want to be careful about refinancing is refinancing federal loans into a private student loan. Because the federal loans have a lot of superior repayment benefits than the private student loans. And you may not realize it, but those have a financial value, and you may be getting a lower nominal interest rate, but losing out on all these valuable benefits. So let's review what those benefits are. Federal loans, right now, they have that payment pause and interest waiver through September 30th. Private student loans are providing only a 90-day COVID-19 forbearance, which is a suspension of the repayment obligation, but there's no interest waiver, which means you're going to pay more, and the interest that accrues is going to get added to the loan balance, so it's going to cost you. Federal loans have better deferments and forbearances. They have the economic hardship deferment and unemployment deferments. They have longer deferments, 3 years versus 1 year, longer forbearances, 3 years versus 1 year. And the federal government pays the interest on subsidized loans during a deferment, which is a benefit that you don't get with private student loans. Death and disability discharges is another difference. All federal loans are discharged, canceled, if the borrower dies or becomes totally and permanently disabled. Federal Parent Plus loans not only are discharged upon the death of the parent, but also upon the death of the student on whose behalf the loan was borrowed. Now, private student loans, some of them do offer death and disability discharges. Among the refinance, about 2/3 offer a death discharge, and a little bit less than half offer a disability discharge. It's a little bit higher for both on new loans, and about 3/4 provide death and disability discharges. There are also other discharges that are available from federal loans, but not from private loans. If your college closes while you're enrolled or within 120 days of your withdrawal, your federal loans can be canceled. No similar benefit on private loans. Identity theft discharges, false certification discharges, unpaid refund discharges are all available on federal loans, but not private loans. Also, federal loans have more flexible repayment plans like income-driven repayment. Private student loans do not. There's actually one loan from Rhode Island that has an income-based repayment plan, but all the others don't, and that's a state loan. Federal loans offer extended repayment. Private loans will be resistant to changes in repayment term on fixed-rate loans, more flexible on variable rate loans because their costs on a variable rate loan float with the repayment term. They don't with a fixed-rate loan. And then there are loan forgiveness for federal loans. There isn't loan forgiveness for private loans. In particular, there's public service loan forgiveness, teacher loan forgiveness for volunteering, for military service, doctors and nurses in national need areas, veterinarians in national need areas, and lawyers who are involved in public interest law, like public defenders and prosecutors. There are some loan forgiveness options for them for federal loans, but not for private student loans. And also, in general, the federal student loans are less expensive than the private student loans. Let's dig into that a little bit. So the first issue is that the federal government pays the interest on subsidized loans during the in-school and grace periods and other periods of authorized deferment. So you graduate, you decide to go back to school to get a graduate degree. Your subsidized loans will have the federal government paying the interest on them during that subsequent in-school deferment. It's not just your initial in-school deferment where the government pays the interest. Federal student loans, they're not credit underwritten, so you're going to get the exact same interest rate regardless of whether you have good or bad credit. Whereas the interest rates on private student loans depend on the credit scores of the borrower and the cosigner, if any. Interest capitalization, where if you have interest accruing, say during a deferment or forbearance, it gets added to the loan balance once when the loan enters repayment, whereas private student loans may capitalize that interest more frequently as monthly. Now, the interest rates that you see for a private student loan are the best advertised rates. They're not necessarily the rate you're going to get. They're not actual interest rates. Your interest rates depend on your credit scores and the credit scores of your cosigner. Unless you have a FICO score in the 800s, you're probably not going to get that best advertised rate. In fact, most borrowers end up with the highest interest rate that's advertised as opposed to the lowest. So you need to actually apply for the loans to find out whether or not you're going to qualify for a lower interest rate. The fixed rates on federal student loans to undergraduate students are lower than the fixed rates on private student loans. Now, there may be older loans that you have that are fixed rates for undergraduate students, but they were at a time when interest rates were higher. Well, you might be able to get a lower interest rate on a private student loan if you have excellent credit. But for this year, comparing to this year's loans, you're going to end up with a lower interest rate on the federal loans. Now, as I said, private student loans sometimes get you a lower interest rate. There are three scenarios. One is what I mentioned, that an older loan on an older federal loan may have a higher interest rate than prevailing interest rates, even on fixed rate private student loans. So you may be able to refinance and save some money. If you have excellent credit, you may be able to get a lower interest rate on a private student loan or private parent loan than on a new federal Parent Plus loan. and that requires you to have excellent credit, and we're talking in the 800s. But otherwise, the pricing on private student loans is not going to be competitive with the interest rates on federal direct Stafford loans, at least not current loans. And the other reason is that the private loans may have lower interest rates is if they have a lower interest rate on a variable rate. So that may initially be lower than the fixed rates on a federal loan. You have to be careful, though, about comparing a fixed rate with a variable rate. The only benefit for a variable rate, because they tend to be priced to have the same cost as a fixed rate loan over the same time period, would be if you're planning on paying off that debt quicker so that you can pay off the private student loan that's variable rate before interest rates rise too much. So now let's ask, will you save money when you refinance your private loans or federal loans into a private student loan? Usually, when you're refinancing loans into a private student loan, they're going to be doing two things. They're combining a lower interest rate, potentially, if you have better credit, with a shorter repayment term. The shorter repayment term sometimes enables the lender to offer a lower fixed interest rate because they don't want to stretch it out for a decade or more when the interest rates might rise a lot more. So if they keep it short, the likelihood of interest rates rising too much is negligible. But you often see these advertisements where they have these really low interest rates and they claim that it's going to save you tens of thousands of dollars. Well, let's dig into this and see if it's really true. So what I have found by doing careful analysis is that most of the savings that you get is going to come from the shorter repayment term, not from the lower interest rate. A shorter repayment term increases the monthly payment, reducing the total interest paid over the life of the loan. And then most of your monthly payment is going to be applied to the principal, not interest. So if we look at an example, if you have $50,000 in debt at 8% with a 25-year repayment term, and you refinance it at 4% with a 7-year repayment term, and you're cutting the interest rate in half. Now, cutting the interest rate in half doesn't cut your loan payment in half. In fact, it's usually reducing your loan payment by only about 10 to 20%. But if we look at the monthly payment, in this particular example, because we're changing the repayment term, not just the interest rate, your monthly payment is going to be slightly less than doubling. It goes from $386 to $683. The total payments, however, and that's going to drop tremendously from $115,000 to $57,000. That's a savings of about $58,000. That's huge savings. But if we were to change only the monthly payment without changing the interest rate, so it's still at 8%, the total payments, instead of dropping to $57,000, they drop to $68,000. So that's a slightly lower savings. It's about $47,000. And you pay off your loan balance in 8.5 years instead of 7 years. So you're still saving a lot of time compared to 25 years. But as you can see, the savings from changing just the monthly loan payment is about 4/5 of the total savings if you were to change both the interest rate and the monthly loan payment. So the savings from having a lower interest rate is only about 12% of the total savings. The remaining 6% is coming from synergistic effects between having a shorter repayment term and having a lower interest rate. Now, the thing to realize is that you can choose a shorter repayment term without refinancing loans, just by making extra payments on the loan. There are no prepayment penalties on federal or private student loans. You just need to be careful to tell the lender that these prepayments should be applied as extra payments to the principal balance of the highest rate loan and not as an early payment of the next installment due. So there is some savings from the lower interest rate, but most of that savings is coming from the shorter repayment term. If you pay more a month, you're going to save more. So now let's talk about how you go about consolidating federal loans. You go to studentaid.gov. There used to be a website called studentloans.gov that made this a lot easier, but they merged it into studentaid.gov. If you go to studentloans.gov, it'll just redirect you to studentaid.gov. You're going to need a login with your FSA ID. That's the same username and password that you used to submit the FAFSA. You might have to, if it's been more than 18 months since you used it last, you might have to reset your password. And you look around and you find a consolidation loan application and promissory note, and you will need to choose which loans you're going to consolidate. So you can leave loans out. There's a question about public service loan forgiveness. You're going to answer yes to that if you're pursuing public service loan forgiveness. That changes your loan servicer to Fed Loan Servicing, the loan servicer that specializes in public service loan forgiveness. And otherwise, you will choose a new loan servicer or keep your existing loan servicer. You will also choose a repayment plan. And if you want to keep your grace period and just consolidate at the end of that grace period, you need to tell them when your grace period ends, the month and year. And then you're going to need to provide your personal information, your name, your social security number, your date of birth, your permanent mailing address, telephone number, email address. If you have a driver's license, your driver's license information, your employer's name, address, and telephone number. And the primary reason why they're asking you for this information is to know where to send the bills, and if they don't hear from you, to help with the skip tracing. And then they will also ask for 2 adult references. Again, the purpose for this is for skip tracing. If you move and forget to tell them of your new address like you're supposed to, they will contact your references and ask them if they know where you moved to, and to give them your new address so that they can send the bills to you so that you don't go into default because they can't reach you. They can't send the statements to you. Now, the references, unlike a cosigner, are not obligated to repay your student loan debt. They're simply to provide that information on your current address. So your parents, your brother, your sister, someone like that. They have to be an adult over age 18, but otherwise you can, anybody who knows you well, who's known you for at least 3 years is a good person. And then after you submit the form, you'll get a confirmation email message. Keep that. Don't throw it away. Maybe even print it out and put it in the folder. And then your loans will be consolidated. You'll get a new loan, and you'll be paying to a new loan servicer. If you were doing auto debit, you're going to have to redo that because the loan servicer is different. Eventually, they're going to fix that so that you don't have to change your auto debit because the name of the loan servicer changed. They're doing a new next-gen loan servicing system where it's the federal government who is the one that the auto debit is with, not the loan servicer. Now let's talk about how to refinance federal and private student loans into a private loan. First thing you need to do is to check your credit reports. You can do it for free at annualcreditreport.com, which is a website set up by the Federal Trade Commission. You get to you can get 1 free credit report from each of the 3 credit bureaus once per 12-month period. Normally, people will spread this out, doing 1 every 4 months, looking for issues. But when you're getting new credit, it's a good idea to do all 3 of them at the same time, because you don't know which of them, Equifax, Experian, or TransUnion, the private lender is going to use when they're deciding whether to approve your loan and what interest rate to give you. And then it's important to see what your credit reports say so that you can fix any errors in that credit report. And each credit bureau may have different errors. So you're going to need to fix those errors. Now, if there's derogatory information that you don't like, but it's true, you can't really fix that. But if there are any genuine errors, like they merge your credit reports with someone else who has the same name as you, or someone who lived at your address after you left, well, then you need to fix them because those errors can affect your credit score, which can affect the interest rate you get. You do that by disputing the the incorrect information, the creditor will then have 30 days from the date you dispute the information to either confirm the accuracy of the information or to remove it from your credit history. And then, so you should wait 30 days after you dispute information before you apply for a private refinance. Now, eligibility for that private student loan is going to depend on other factors as well, such as your income, the duration of your employment, and your debt-to-income ratios. Now, you need to identify all the loans that you're going to want to refinance, gather their loan ID numbers, the loan amounts, and other information. This is important for two reasons. One, the lender can't refinance a loan that you don't tell it about. But the other reason is that some of the lenders will only refinance certain amounts. Like some lenders will only refinance up to $150,000 in student loan debt. So if you're a medical school graduate that has $400,000 in debt, which is an insane amount of money, you might have limits on which lenders are going to be willing to refinance that amount of debt. So many of them will say, well, you're a doctor now, well, we're willing to do it because you're really low credit risk. And then the next thing that you need to do is to shop around. The best advertised rate is not necessarily the rate you're going to get, so you need to apply for the loans to see what the actual interest rate you're offered. Don't worry about this affecting your credit because most lenders on an initial application are going to use a soft inquiry as opposed to a hard inquiry. Once you accept the loan, then they will do another credit inquiry, and this time it will be a hard inquiry. And even if a lender is just doing a hard inquiry on initial loan applications, the credit bureaus now recognize shopping around behavior. So if you do those applications within a short time frame, say a week or two, it's not going to count as though you're trying for multiple loans. It'll be treated as though you're ultimately going to get just one loan. And once you pick a lender, you will need to apply for the formal refinance with that lender, accept the lender that offers you the best rate is usually the best advice. One bit of advice is to apply with a cosigner because that is usually going to get you a lower interest rate, especially if that cosigner has a better credit score than you do. Now, when you're exploring and looking at various lenders and you want to evaluate and compare the loans, and we have a new refinancing calculator, which lets you look at before and after refinancing, what it does on your monthly payments and the total payments based on the new and old repayment terms and the new and old interest rates. And this particular example shows a $30,000 loan at 5% interest rate with a 10-year repayment term, comparing it with a 4% interest rate on a 7-year repayment term. And as you can see, the shorter repayment term means a higher monthly payment, even though the interest rate is lower. The total payments, however, are lower because it's a shorter repayment term, so there's less interest accumulating, and it has a lower interest rate. Now we have another calculator called a student loan comparison calculator. And this one lets you compare multiple loans, 2 or more loans at the same time. You can just keep on adding the loans. And it's going to show you the monthly payments, and total interest, as well as how long it's going to take before your loans are paid off. And then it automatically flags the loan that has the lowest monthly payments and the loan that has the lowest total cost in the right column. And again, this involves similar example to the previous calculator, all involving $30,000 in debt. The first one is 5% with a 10-year repayment term, then a 4% with a 5-year repayment term, and then a 4.5% with a 7-year repayment term. Just as an example. But you can take all your refinance offers that you've received and you plug them into this calculator, and you can then side by side compare them to see which ones are giving you the better deal. So thank you. We'll now open it up to questions, and if we don't get to all the questions, I will be writing articles based on the questions that we received to try to answer everybody's question on our website, and we'll send that out to everybody after I've written them.
Thanks a lot, Mark. Just so everybody who's on this webinar knows, I just sent a poll for you guys to quickly fill out. Mark's going to be answering questions, but if you wouldn't mind filling out that poll, would help us a lot in terms of feedback and planning for next webinars. So Mark, to kick it off, we have one question asking about high student loan balances. In particular, what repayment options do you recommend for people with loan balances in excess of 100,000 that do not qualify for forgiveness options or income-driven repayment plans?
Right, so if you're looking for the lowest monthly payment, usually extended repayment is going to give you a lower monthly payment. There is something called graduated repayment for federal loans that starts off with payments that are just barely above interest only, and every 2 years it will increase that monthly payment. And it's subject to a constraint called the 3 times rule, that no payment can be more than 3 times any other payment, which makes calculating what the monthly payments are a little bit complicated. We haven't yet implemented such a calculator on our website, but we'll probably do that in the future. But it's usually extended repayment or graduated repayment that has the lowest monthly payment, at least initially. But if you're looking for the highest monthly payment, then what you want to do is stick with standard 10-year repayment, or maybe you choose a longer repayment term so you have a smaller monthly payment, but then you make the same payment you would under a 10-year repayment term. That will yield, effectively, you'll be in a 10-year repayment term if you're making the same payment as on a 10-year repayment. But if you run into financial difficulty one month or another, you can just revert back to the monthly payment that your loan term calls for, and so you get temporary relief without having to switch repayment plans back and forth.
Sounds good. And then what about, you talked about credit reports. Some people are asking if you use one of these free credit report tools, does that hurt your credit score at all?
No, it does not. One thing to be careful about when you're using annualcreditreport.com is you may get pitched by these credit bureaus for credit monitoring services or to get a copy of your credit score. The credit report that is just your credit history is free, but the credit scores they may charge you for, and resist the temptation to pay money for that because you don't really need that. If you're curious about your credit score, there are some lenders that will provide you with your credit score for free. I mean, some credit card issuers do this. Even some of the lenders will do this. So that can give you an idea of what your credit score is. And obviously, each of the 3 credit bureaus has a different credit score. And they may even have multiple variations. There's something called the Vantage score, which is not really a real credit score. Well, it's not in common use. And there's also third-party websites that you give them permission to access your credit history, and they will then use that to generate their own variation on a credit score, similar in concept to those of the traditional credit bureaus. But once again, looking at your credit report is not considered a hard inquiry, and therefore it will not affect your credit score.
Gotcha. We had one person toward the beginning of the webinar ask, even if you refinance to a private loan, does it make sense to do that in increments? So you're keeping some with the Department of Education in case the federal government decides to forgive all or parts of student loans, as several candidates have talked about.
All right, so when you refinance a federal loan into a private loan, that's a purely private loan. If the federal government were to forgive all federal loans, your private loans would still exist afterwards. Now, if you keep some loans with the federal government and some with the private, and the federal government decides to forgive all federal student loans, then you would only get forgiveness of the loans that you kept with the federal government. So that's a trade-off you need to consider. What's the likelihood of the federal government forgiving all federal student loans? Well, I mean, consider that during the recent run-up to the presidential election, there were 25 major Democratic candidates. Of them, only 4 had proposed widespread loan forgiveness. The others were doing just for teachers or just for low-income individuals, but not for everybody. So if a Democratic candidate for president gets elected, they will not only have to convince the Republicans to support loan forgiveness, but they'll also have to convince the Democrats. Because in loan forgiveness of all federal loans, that's over $1.5 trillion. That's really expensive. There's a lot of hesitancy about it. Now, the HEROES Act, which has passed the House but is stalled in the Senate, would forgive up to $10,000 of federal loans and up to $10,000 of private loans. Originally, it was going to be for everybody, but then they kind of got worried about the cost because there are 45 million borrowers. $10,000 per borrower is $450 billion, and so they decided to do it only for people who are economically distressed. So people in default, people in income-driven repayment plans, and the like. So that's about half the borrowers, and so that reduced the cost from $450 billion to a little bit over $200 billion. But even that may not pass the Senate because Republicans are generally don't feel comfortable with loan forgiveness of any kind. So I don't think it's likely that we're going to see widespread loan forgiveness. We might see better targeted loan forgiveness in specific circumstances, like we might see bankruptcy discharge become available for federal and private student loans. But I don't think we're going to see everybody gets their loans canceled.
Gotcha. We had somebody else ask, any suggestions or recommendations on particular lenders, banks to use for refinancing purposes?
All right, so we are going to be launching in a few weeks a automated 5-cap rating system for student loans. We're going to do it for undergraduate loans, graduate loans, parent loans, and refinance. And this is 100% formulaic. There's no subjectivity in the ratings, completely objective ratings, and it's based on several dozen data points that we've collected about each and every loan. And so watch for that to come out soon. It is going to help you compare all the various lenders and loans to highlight some of the key differences among them, and also give you an overall sense as to the quality of the loan. Now, you may be worried, well, if I wait, will the interest rates go up? Well, right now we're in an environment where interest rates are at historic lows. And private student loans, both refinance and new loans, are usually pegged to the 1-month LIBOR, or the 3-month LIBOR, or the prime lending rate. The 1-month and the prime lending rate are an average over the previous month of those indices. The 3-month LIBOR is an average over the last 3 months. Since the Federal Reserve reduced interest rates in mid-March, we have April, May, and June, so it's going to fully phase in for the 3-month LIBOR probably sometime in July. So I would expect interest rates to go down a little. Now, if you're worried about, well, maybe I need to keep my federal loans with the federal government because of the payment pause and interest waiver, well, and if you wait until September, they're probably still going to be relatively low. I doubt they're going to go up. In fact, they probably will stay low for an additional year and through the end of 2021. So, and I wouldn't be too worried about interest rates rising for the next little time. But it's hard to predict these things, so take that with a grain of salt. But I think you can afford to wait and do comparisons and give another month or so for the interest rates to all have reached their lows. And then if you're considering refinancing private or federal loans into a private loan, that would be the time to do it. And we will be providing these new tools. They're in beta test right now that will help you make an informed, smart decision about comparing the lenders. And even with our ratings, you don't pick the top lender that's rating, and pick a bunch of them and apply to a bunch of them to see what rate you get with that lender, because your individual interest rate may be different than the best or the worst interest rates.
Awesome. Thanks a lot, Mark. We're hitting right at 5 p.m., so I'm thinking we're going to conclude this Q&A period. Like Mark said, just to second that, He's going to be writing articles talking about all of the questions you guys have sent. So keep sending questions if you have them. And Mark, if you have any final thoughts to leave the crowd.
No, I think we've covered it. I am going to be writing up answers to all the questions so that you will be able to learn a lot, not just from your own questions, but from everybody else's questions. I find that this is a great way of getting ideas for articles that really matter to people, because they're the questions that everybody is asking.
Great. Thanks a lot. And thank you everybody for joining. Have a great Wednesday.